give your download on the current state of the European financial services market.
It's definitely seen an upward trajectory and momentum around the talent market in particular. Most, if not the majority of financial institutions had a good 2024 versus the previous 2 years, right? And that increased level of profit that's come, especially across the banking sector, across the buy-side institutions that we work with, have resulted in better payouts. Candidates who are at the MD, D grade, even C-suite level, are more likely to make a move at this time of year, naturally because they work off the top perspective, they've been paid bonuses, and that's when they look for new opportunities if they've been paid well or not been paid well.
What would you say is the leading, most important benefit that candidates are looking for these days? Is it traditional like 401k match? What do you see? Now that we have completed our US talent survey mini-series, it's time to move on to Europe. This episode is my sit-down with Matt Nicholson, head of Selby Jennings Europe, to discuss the findings of our Europe talent survey for financial sciences and services. We talk about similarities and differences between the global markets and why volatility and movement is good for business all around. If you're interested in reading the full report, it is linked in the show notes of this episode and available at selbykennings.com.
Hi, Jesse. How you doing?
Very well. Very well. We have a little bit of London weather today, unfortunately.
Oh, not here. Bright sunshine here, so you're missing out.
Thanks for doing this. Obviously, the right person to talk about Selby Jennings Europe for us. We have our new talent survey report and the salary and bonus findings for our Europe market now. So that's what we're going to talk about today. I would say just generally, we're definitely going to get into some of the statistics behind things and the trends that you and your teams have seen. But so far, before we dive into the data or the details of it, what do you think the temperature of the market is right now? Obviously, the tariffs have been an ongoing global phenomenon, shall we call it, and things are affected in various regions. So just give your download on the current state of the European financial services market, and then we'll get right into the report.
Look, I think it's, I wouldn't say completely night and day from where we were this time last year, but it's definitely seen an upward trajectory and momentum around the talent market in particular. That has been refreshing based off the previous 18 months and that post-COVID boom that we all loved and went through. And it's been across most of the verticals that we cover for Selby Jennings. And from a macro perspective, across Europe for that matter, most locations that we operate within, and we obviously we're in a few here. We're in London, we're in Germany, we're in Amsterdam, and we're in Switzerland, have all been buoyant versus where we were at this point last year. We're coming off the back of bonus season. The fluidity in the market has definitely picked up. The musical chairs, chess pieces are moving around much more than they were 12, 18 months ago, which creates a lot of optimism. And the report we're going to talk about today, the data that we've got from that definitely shows that. And it's a good time to be in financial services off the back of a good performing year last year. And we're in a good spot in terms of where we stand right now.
Great. Well, love to hear the consistent optimism because we're kind of feeling the same thing here in the US. And I think what you just mentioned there about getting into the data based on the attrition kind of being a little bit higher this year, the movement being a little bit higher, maybe we'll be able to tie some things together. So let's get to it. The first thing I want to point out, we're going to talk about salary increases and expectations, bonus survey findings and increases, as well as just some more general trends. So the first thing is that according to our respondents in Europe, 57% said they had a base salary increase in the past year. That could be interpreted as more than half. It could also be interpreted as just over half. What have you seen? Did you see pay rises increase across the board?
Yeah, I guess the broad takeaways are most, if not the majority of financial institutions had a good 2024 versus the previous 2 years, right? And that increased level of profit that's come, especially across the banking sector, across the buy-side institutions that we work with, have resulted in better payouts and increased basics. And I think that a number of those institutions have rewarded staff, and that sentiment has been seen in the candidates and clients that we've been speaking with, and it's created a great level of optimism in terms of what has happened with the migration of talent through the market. And Look, there is some institutions, there's some individuals, as you'll see from the report. We don't want to go into too much detail because we want people to make sure they download and read it.
Exactly.
And I think some of the optimism that's come from has been, in most part, through, I say, front office performing functions. So your sales and trading, your private markets, investment management businesses, your hedge funds. That's where I think the increased compensation, basics wise, bonus wise, has definitely been, and I think that has continued throughout the last starting point of this financial year as well. So yeah, look, we've had some instability, also volatility with what's been happening with the tariffs, etc. And like you mentioned earlier, it's a phenomenon, right? It looks like the market is quite quickly stabilized itself, and it's a blip, right? And we'll see what goes. But as the past few years have shown, volatility is a good thing for a number of institutions that we work with, and a lot of different candidates that we work with too.
Most definitely. Again, consistent with what we've seen in the U.S. here. The front office performances were pretty strong. I think maybe, expectations, maybe the results of the U.S. survey where expectations may not have been hit as much, only because the front office teams had such a good year that they were probably a little bit full of themselves and expected to be paid better. But that's a conversation for a later day and maybe a front office specific episode. So one other thing I noticed in the Europe salary findings was that the highest percentage of respondents said that they are making 90K euros or 90K pounds or less. Not the majority of all survey respondents, that was just the highest percentage. Would you say the majority of roles we are supporting right now are that, associate or even AVP level, a little bit more junior? And is that where the activity is in the market on the Europe side? Or is that happens to be who responded to the survey right now?
I think that's a bit more about the respondents of the survey. There is naturally a bigger pool of individuals who are probably more willing at that level to fill in the survey results. But I would say that's not any sort of translation to the area of the market that we operate with, or what we're seeing within the market in terms of the more senior end of the spectrum. Naturally, candidates who are at the MD, D grade, even C-suite level, are more likely to make a move at this time of year, naturally because they work off a total comp perspective, there's been paid bonuses, and that's when they look for new opportunities if they've been paid well or not been paid well, depending on their situation. So I think this year we've probably seen 20 to maybe even 25% increase at D-level plus positions that are coming into our world.
That's right, we have.
That's great, right? That just shows that the market is good. It looks like it shows that the market is open at all levels of seniority for people moving, and naturally the senior people who are looking for new opportunities, it means that companies looking to grow. You don't hire individuals at that level unless you want to scale out businesses or scale out teams. It's not all about attrition hiring or attrition replacements that we've probably seen in the past kind of 18 months. There's a lot more new build outs. There's a lot more greenfield projects that are getting signed off in the quantitative systematic space, but also technology, which has been a relatively quiet vertical for us in the past few months. And yeah, look, that's an exciting time for us.
Fair points there. So according to the survey here, we'll stick to the salary stuff and then we'll move on to bonuses. And I know the removal of the bonus cap as well as something that is worth chatting on today too. The sectors, again, according to the findings for the Europe report, the sectors that were most likely to have received a salary increase were investment banking, 64%, investment management, 58%, and compliance, 57%. Some of the other middle office or fin ops verticals didn't receive as much of a salary increase, if any at all. Again, is that consistent with what you've seen? More of the front office teams seeing the bigger increases?
Yeah, absolutely. I think as 2024 showed, it was a good year. Profits are up. They were getting rewarded within the revenue generating functions, and we're not surprised by that at all. I think that's what's translated into banking candidates, not just buy-side candidates who've been having a good time with it in the past 2, 3, 4 years. We've also seen it across all institutions, and I'm surprised a little bit by the compliance one to the degree that the survey came back with, and it's a large amount of individuals that came back on that survey that work within that vertical. However, look, regulation doesn't go away. It's still there. I think for a number of different businesses, the necessity to have the right individuals that are able to face off with regulators, that are able to face off within the institutions themselves is so important. So
yep, no off season for that.
No, exactly not. And look, it's an evergreen market in a lot of senses. It's always there. It's always active, and we've seen, especially across some of probably the market makers, potentially the hedge fund space, the crypto world as well, as obviously it's bounced back. The need for regulation and compliance professionals in that space is definitely, and the appetite for that has definitely grown, and that's probably translated into higher comp in the basic side. In terms of the kind of FinOps, corporate functions world, I think it's probably relatively reflective of what we've seen as well. There isn't dramatic base increases. It's not a total comp market. It's to the same degree as some of the revenue generating world is. So I think it's really steady. However, that being said, we have seen an influx of positions coming available, and as I mentioned earlier, definitely at the D grade as well in that world.
Yep, great. Again, just to jump ahead a little bit to the bonus section, then I want to close out the salaries. The point I'll make is similarly, the sectors that were most likely to have received a bonus and were generally happy with or the increase of their bonus or the payout. Front office, again, 79% investment management, 78% investment banking, 76% sales and trading. So kind of just continues with the theme there that the front office teams in Europe were rewarded this year. The employees seemed to be pretty happy. In the US, part of the conversation was, did meeting expectations mean they were happy? It seems that was actually the case more so in Europe, would you say?
Yes, I'd say, look, Europe operates very differently in slight nuances in terms of the cultural differences and the slight differences between verticals depending on the country that they're operating within. I think the UK market has been, I would say, definitely from a comp perspective, outperforming Paris, Frankfurt, Amsterdam, and the Swiss market to a degree as well. So yeah, I would say there is definitely some confidence in terms of what's coming out from the total comp perspective. But I would say there's probably some nuances in terms of the geographical splits. Something we actually don't do in the report is break it down from a geographical perspective, and it's something for when we do this we do annually. We are going to do next year for sure.
Then let's move on to the bonus stats. 69% of our respondents in Europe mentioned that they received a performance bonus in the last year. Again, I ask you, consistent with what we've seen, does that seem low, high?
That's pretty consistent. I'd say maybe a little bit low, actually. I think a lot of the commentary from the market and from a number of different media outlets, whether that be UK, Europe, stateside, has been that this has been a fantastic year for bonuses based on profit levels that companies have had, and the performance of a number of different functions across the bank. It was a great year for equities. It was a great year across a number of different asset classes, and I think that's been translated into what bonus payouts were. What is interesting was this was the first year for the UK, for example, where for some institutions the bonus cap was removed, which was an old tie to EU legislation. Yeah, the EU legislation that we were tied to post Brexit. It hasn't really moved until now, and some institutions have not removed that cap. It stayed in play. Primarily the institutions which are tied to the EU still from a headquarters, so European banking. But we've seen the US investment banks very quick to remove it. Barclays removed it as well. And there is a few reasons behind it. Obviously, for a UK perspective, the talent migration to Europe, or to make it, we wanted to hold from a UK perspective. And I think from a talent attraction perspective, naturally, if you are based in mainland Europe, your comp opportunities or total comp opportunities are going to be dramatically improved by being the UK versus another financial hub in Paris, Frankfurt, Amsterdam, et cetera. So that has translated, and again, we haven't broken it down geographically, but from the sentiment in the market, that has translated a pretty dramatic increase for certain very high performing individuals who have broken through what was the original cap that was in play. So that's been a real interesting change and shift. Has it to the degree we might see next year when it's been in place for a little bit longer? Not sure. It's an interesting thing to look at, but also there's a disparity between the institutions that have removed the cap and who haven't. Will that mean a difference in terms of where talent migrates to between those types of companies? I'm not sure just yet. It hasn't probably come out in the movement of the market in terms of candidates, but I expect it to.
Tell me more about institutions that have not yet versus those who have. Is there a mandate or a timeline that everyone must do it by a certain timeline? Is this entirely voluntarily?
It's entirely voluntary. It's entirely voluntary, and there's no prerequisite to remove the cap. You don't have to. I think that if you are working as a mainland Europe institution and headquartered, whether you be a German headquartered bank or a French headquartered bank, to then change the cap for employees in the UK, to that not change it, obviously we're able to change it because of EU legislation in the Paris or Frankfurt markets, is a little bit sticky in terms of an internal, it's just a sticky internal challenge, and so they can do that. But if you are a US headquartered bank where you were only tied to the cap because your business was placed in the EU, it was very quick to remove, and it didn't make much difference. And that will be the same for any bank that works in that company for the UK. So it's an interesting dynamic shift. I think when Brexit first happened and came about, it was always going to be, where was the talent going to go in Europe? And I would say that the probably made winner has been Paris. I think primarily because of the talent pool there is excellent. The infrastructure is there to be able to take on more banking or financial services talent. But also it's just a good location to live in, right? Like Paris is a good place. No slight on Amsterdam or in Frankfurt either. But I think, that was what one of the main attractions was. And that migration talent has been happening. I think this may slow it down. It may shift in terms of how that works, especially for front office revenue generating candidates. That's kind of where it lands.
Got it. Thank you. So there's a really interesting point. Again, we don't want to share too much of the report. We want people to read it, as you said. But there's a really interesting point in here about how 86% of professionals said they would consider making a move for stronger bonus potential. I think that ties really nicely into what you just mentioned about the bonus cap, right? So there could be a legitimate correlation, obviously to something we're not tracking yet, but something that there could be a legitimate correlation between candidates moving from places, in certain locations, again, as you mentioned, where they leave an institution that has the bonus cap, moving to a place that doesn't have the bonus cap, allowing them to potentially have a greater bonus potential, greater bonus earning potential. And I just found that to be interesting because 86%, that's a pretty high responding number. And with so many different opportunities for candidates to potentially join firms that don't have a bonus cap, or essentially have, a much more uncapped financial situation. Wonder if we could, see some trends there, see some movement around that particular correlation kind of thing.
Yeah, no, 100%. I think it's something which we definitely want to delve into in this report and do in part already. But I think I'm not surprised about the number that people in financial services come into, because it's intellectually stimulating, but also because there's good money involved in it, right? And I think people want to have the opportunity to be able to earn as much money for the hard work they do, and that percentage in the high 80s is not surprising.
So I want to move on and just kind of wrap up now with benefits and what motivates candidates outside of the obvious, which is compensation always. So in the US here, obviously, it's largely return to office and those who are still seeking work flexibility, those who might, not want to be in 5 days a week, or their situation has changed since remote became a lot more prevalent and popular. What would you say is the leading, most important benefit that candidates are looking for these days? Is it traditional like 401k match or medical and health benefits? What do you see?
Yeah, I guess it's a number of different components there, right? The return to work, return to office, work from home, the flexibility, whatever you want to call it, I think is something which is always on the agenda of candidates we work with these days. Post-COVID, it is something that is an expectation, and I think that's an expectation across all seniorities as well. I think it's not just parents or people who have other responsibilities in their lives. It's from top to bottom that people have an expectation that there will be some element of work from home, flexibility, etc. within their working dynamics. So that being said, there is a shift change. You've mentioned the return to office in a number of institutions has been pushed as an odd part of the agenda a lot harder in the past 12 months. I think that's been primarily because of performance has been good, and we want you back in the office, and we want to continue that. And I think just from a cultural perspective, some of the institutions that have always been built that way and want to go back to that way. I think you look at US investment banks, for example, that's definitely, there's no doubt about it, Goldman's, JP have been very public and very open about the fact that they want people back in office. I think some of their European counterparts have been a little less punchy, to say the least, in terms of how wanting to have people back in the work. I think it also depends on the function, right? Like, I think if you're in a front office environment, typically you're going to be office based. Like, that's just how that operation
nature
works.
of the business. Yes.
Right. And I think if you're in a function which is facing off with a number of other different business units, for example, risk or potential compliance, then yeah, you're more likely to be office based. I think if you're working in some of the FinOps, audit, accountancy, finance functions, it's pretty much the same. Like, I don't see there being a huge demand to drive those functions back into the office, and that won't change. So I'd say, yeah, flexibility, work from home is probably one of the biggest drivers in as a benefit, or something that is definitely spoken about a lot more during the interview process, and especially by some client attraction strategies as well. Like, I think if you are at a more dynamic business in terms of, or in a different phase of their business, so if you're in a growth phase, you are going to want people in the office, and you are going to push that. If you are more stable, it's not necessarily part. The need to have you in the office is probably going to be less. Again, it's also dependent on the function. I also think pensions are still a big part of it. I think looking at stocks, equity, that is a huge part as well. That gets talked about a lot. I think as deal activity has increased, startup businesses have been attractive again to go to, and generate equity will be part of the equity structure that they have within that business as well. So that's something that, again, with a number of different candidates and customers that we work with, that is a spoken topic.
40% of the respondents said it was, quote, very important, and 41% of the respondents said they actually have flexibility to work from home 2 days per week. 18 said 1 day per week. 20% said 3 days per week. So I think you're right on with that analysis. It seems to be, it's prevalent across the board, definitely in Europe and America, and is important for both candidates to be able to have either maintain leverage or use as a motivator, and for employers to be aware of and determine for their corporate strategies as well. Like you say, there are certain groups that you kind of, if you're in that skill set, then you probably should assume that you'll be in, but it's certainly something for clients to be aware of as well. Right. So I want to give you just kind of a spot to highlight what's going on, or what you might expect for the rest of the year, or anything based on the report that, what candidates should do or use to their advantage, anything hiring managers or teams should use to their advantage, kind of based on the findings that we have from our report, just to close out. So last word is all yours.
Sure. I think if we're looking at it from a client perspective, it's, as I mentioned at the beginning, it's been a better environment to operate within. If you're looking for talent, people have been more open to moving. Salaries from a base perspective, from a bonus perspective, were pretty dormant in 2023. There wasn't a lot of movement. It was pretty stagnant, and that has changed and shifted. I think after this latest bonus round, there's a lot more optimism. People are more open to seeking opportunities. We've had a much more increased inbound traffic of candidates coming to us saying, "What have you got? I'm keen for a move. Let's see what we can do." So there's been a lot more excitement, I think, in the UK market. Inflation is going down, interest rates are going down. Like, that's just means more lending. It means more borrowing. It means more opportunity for deal activity, etc. So yeah, like it's a much better environment to be looking for a new role as or looking for new talent as a client, but also as a candidate. It's a great place to start because there's more opportunity out there as the market creates more fluidity. There's more musical chair activity, that you just see people moving, and that's a good environment for the talent market. So I would say from a closing point of view, are we going to see a similar year to the post-COVID boom of 2022? Probably not yet, but it is definitely a return to a more normalized market where candidates are being rewarded for good work and generating good business for their employers. And I think we're seeing more growth hiring happening rather than just attritional hiring, which is good.
I completely agree. I took a step last year. I took a stab to say that 2024 would be the return to normal. I couldn't have been more wrong. So I'm glad that you agree that I'm not wrong 2 years in a row, because I agree we're certainly seeing it a bit of a pre-COVID normal recruitment cycle, activity cycle this year. Well, great. Matt Nicholson, one of the first 2-time guests on Searching Smarter.
Exciting.
Thanks for the chat. Good to have your insights as always, and I will see you soon.
Great to catch up, Jesse. Look after yourself.
That's all for today's episode of Searching Smarter. If you found this conversation valuable, be sure to subscribe so you don't miss an episode. Until next time, keep searching smarter.